thank you so much, George. And thank you for having the honor to have this chat with Mr. Francisco Garcia Parames. Thank you so much, Francisco. So the idea is probably to ask you about some of the things you have learned in your career and the moments that have determined like who you are and how you invest. But we are in a value investing conference in the year of the retirement of Warren Buffett. I don't know if maybe we should start with, I know it's very difficult to summarize a few lessons from Warren Buffett, but I don't know whether there are a couple of them that come to the top of your mind that would like to highlight.
Okay. Well, perhaps the first lesson is to be patient, which I think is the key element in any investment decision that we all have to make. And I mean, actually, the book I wrote was called Investing for the Long Time. So, I mean, be patient and having the right attributes to invest, which are far more important than just IQ, which it's good enough. But if you have the right personality, it's something that is much more relevant than just have a bright mind. So actually, well, I can speak about very good investors that have average minds, and the opposite, really bright people that really allows investors. So that's my experience. So I mean, you know, lots of things. I mean, I don't remember now the many things that we can learn from Warren, but from me, clearly, I mean, you know, being patient and taking the time for things to happen is the main thing. Also, it's important that he himself exists in a sense that, I mean, I was starting to invest in 1990 in Spain, so you can understand that there was not any value investor or anything that was related to that. I mean, the language didn't even exist at that time. So coming across Peter Lynch, Warren Buffett, and all the guys, was a kind of a life saving for me, in the sense that when all the bad times came, precisely, for instance, in 98, 99, you knew Warren Buffett was there and was having the same issues that we had. I mean, we all remember the front page in the Barron's, "Where are you going, Warren?" So, okay, where are you going, Francisco? Was exactly the same thing. So you feel accompanied and helped by his presence and his wisdom and everything what he said in the annual reports every year. So it was more than particular things. It was his general idea of being alive.
Yeah, you already mentioned like personality, the way you are, and how that translates into your investment decisions. So, and about, you have talked about your book where you explain all that process. But yet, just curious, do you remember the moment where you decided you would become an investor? Because you educated in, you are an engineer, right? Or
no, you studied? No, I earned my MBA in Barcelona in '89, and I was hired to help analyze kind of private equity style investments for the small company that was called Vestinberg at that time. And I didn't know that I wanted to invest in the stock exchange. Actually, I explained in the book that I thought that this stock market was a thing of speculators and, you know, the typical reluctant to look at this in the right way. And the funny thing is that they made some mistakes, so we stopped doing this private equity style investment for this family. So there was a small brokerage operation, so I just sit there and started to analyze the Spanish companies from A to Z. It was not like in the US, but it has 150 companies. So in 1 year, I mean, they left me alone, so that was happy on that. And I could more or less have an opinion on most of the companies by 1 year. Then the team left. There was a small fund management operation that left, and I asked, can I do that? And so I had been studying for 1 year. They allowed me to do that. I mean, there was such a tiny amount of money. I could say 3 million euros at that time that they didn't lose nothing just letting me managing that. So that's why and the good thing is that exactly at the same time, in 1990, I was going to Mallorca in the ship, and I was reading Peter Lynch's book that came across to me. So at the same time, I was starting to analyze companies. The first one actually was Acerinox. I was in the Felix Voices were there at that time in 1990. Acerinox is the global leader in stainless steel. Well, it was, because now the Chinese are bigger than Acerinox, but it was an excellent company. And at that same time I started to analyze these companies, I started to learn about how do they do the things in John Templeton, Peter Lynch, and all the guys in the US, and Warren Buffett, of course, at the end of the road. So that was the beginning and how I came across all this.
And in all that process was like, you found that value investing was like the perfect fit for your...
It was so obvious. I mean, there's any other way. Buy undervalued assets for whatever it's worth.
But I also think that you kind of have to have certain kind of personality, no, or way of being for really value investor.
Yeah,
I don't know whether...
Well, first at the beginning you have to make concessions. I mean, you just cannot go there and say, I'm going to invest, well, my money said 100% or 50% or 30% of the portfolio in one company. Well, you cannot do it by law if you are using a UCITS or a fund, at least in Europe, right? So you have to be a little bit, as we say in Spanish, you have to have a hand left. So a little bit careful in what you do, and because, I mean, if you are 27 and they give you the trust to do that, you have to go slowly. So that's a clear recommendation. If you are managing money for third parties, at the beginning, go slowly and try to learn and mistakes, and with that, improve your process step by step, right? In the end, the 90s were quite a fortunate time, because actually the Spanish stock market multiplied by 3 from 96 to 98. So it was unique in that sense, because it was an amazing time. So everyone was making money. We actually did the same as the market, which was not that bad. So that helped also to get the trust of the people. And then later you can really make decisions that with much stronger conviction than the ones that you have to do at the beginning. Obviously, you have to do some concessions. Yeah.
And in all that process, are you like able to identify different phases on how you do things? Like we were talking about Buffett. Buffett before, at the beginning, was very much influenced by Graham, then Fisher, then Munger. I don't know whether you had a similar experience, like adapting the investment philosophy.
I had to say at the beginning I was much more influenced by Peter Lynch with the different type of companies, and it was a very useful approach, and I used that. Which, I mean, the cyclical stuff, the growers, and whatever, right? And I used that almost until I was working along until 2003, and then onwards up to 2007 and 8, we were quite a pure value house, in a sense, low stock price stocks, and keep it simple on that. But then at that time, we just pay attention to what Warren was saying, and we started to focus on high quality stocks. And actually, the catalyst was Joel Greenblatt, with his small books about the quality and performance with low price vis-a-vis other stocks. So we went into that, we analyzed that, and we say we had been making mistakes going into the crisis, the financial crisis, with perhaps a lower quality than it should be in the portfolio. So from that moment on, we increased the degree of quality in the portfolio, and we started to focus on high return on capital companies, and that's the same thing as we do today.
You mentioned that your first contact was more with Lynch, with Peter Lynch, than with Buffett. I tend to think that I was lucky that the first books that I read were also Peter Lynch books instead of The Intelligent Investor, because maybe if The Intelligent Investor had been my first book about value investing, I would have stopped at that point in time, and I think that maybe Lynch is a bit better for younger students. Yeah. Given that we have some young students here, I don't know whether you agree with that starting with One Up on Wall Street or Beating the Street is a bit easier than...
I don't know if I should be doing that anymore, but that's the the book I recommend everyone. I mean, my eldest son, that's a book I recommended, the One Up in Wall Street. Perhaps it's a bit old-fashioned, but the general idea of the book, especially the cocktail party theory, is it's eternal. So I guess it's a good starting point still. I have to say I don't read much on investing lately, so kind of perhaps I am stuck in the past.
What are you reading lately? Any suggestion?
I read history, things like that, things about China. I mean, anything, but I mean, how to invest? Well, it's not my priority.
So let's talk a bit about investment process. Do you typically meet management of the companies, and if yes, at what stage? Before doing some numbers, after doing some numbers, or there is no rule?
It all depends. If we have to invest in a 3NOx, by the way, the CEO was my neighbor, so we don't need to invest to meet the management after 35 years. So there is an exception for every rule. So of course you have to. The more you meet the management, the better. The management and everyone that is involved in the situation. But it is not a requirement. In large companies, the added value that you take from management is not very large, because it's what it is. The transcript of the conference calls and no more than that. Sometimes they explain a little better the business model, but it's what it is, so it's not essential. So we do also in that. But I mean, meeting the management of the BMW or Mercedes-Benz, what can they add in that sense? So no, really, right? But yes, in the medium-sized companies, of course, this is key.
Regarding management as well, like, are you perceiving some changes in the new generation of management versus previous generation of managements that could be, I don't know.
In Spain, now they speak English, which is a good factor.
Yeah, that's good.
But not really. No, I wouldn't say that I've noticed any change.
We were talking before about performance, which obviously is probably one of the most relevant topics. And we have always been compared to benchmarks. I don't know what your point on that. You were talking about the IBEX 35, your performance versus the IBEX 35. I don't know whether that is always good to have the benchmark in mind to measure performance. Can you do good things and still not beat the benchmark, or the other way around, like not have the best process and still be lucky to?
I mean, if you manage public funds for public people, I mean, and we have 35,000 clients. I mean, anyone can be client for 100 euros. So we are very democratic on that. Anyone can access our funds. You have to do it right and do it properly and compare everyone compares you to indexes, obviously, but we want to be open. We want to have everyone the possibility of investing in what we think is the right way. So we don't want to close funds. To avoid publicity and having a public fund. That's a fact, but. In the end, the key thing is your personal attitude to investing. So I invest because all my savings are in the fund. So I don't give a damn about the benchmark. If I find a company of 6-7 times free cash flow, great, that's it. And we decide it's good for the portfolio, we go for it, and I forget about the benchmarks. I mean, I don't care for whatever it takes. Having said that, lately we pay a little bit more attention to what's going in the company, because the flows are going to passive investing. So all these small investors may think that the money is not well served when they are not doing that well vis-a-vis the market. So we tried having another twist in our investment process, which is try to understand, which is not easy, but we make mistakes all the time, which processes are more advanced and the market is going to recognize them earlier. So not in terms of what goes into the portfolio, which if a company is trading, what I say, the portfolio is trading at 7 times free cash flow. So if a company is trading at 6-7 times free cash flow, and we like the business, I mean, the average return on capital of the portfolio is close to 30%. So we have a 30% return on capital company, family-owned. We tend to like family-owned companies. 7 times earnings will go into the portfolio, most probably. if there's a business that we understand and we see a perspective for the next 10 years or 15, right? But besides that, you have a position of 1%, and the sizing of the position is something that is very important. And probably the main mistake I've done in my investing life, which was 6 years ago, was in terms of the sizing, position sizing, which was too big for the quality of the company. But when you start with 1%, then you see what happens, and then you have to think, you sit there and you see things happening in the market going up or down, and the company having some issues here and there, or some positive news. So you act on that. And it's very rare that we go directly into a 3-4% position. I mean, it's a long time since we don't do that. I mean, I don't remember the last time we did that. So we go step by step, slowly, depending on what is happening. And the Andrew graphs is exactly the one that we use. I mean, we use the target price of the portfolio and our shares, and depending on how the company is behaving vis-a-vis the rest of the portfolio, we act. We increase the position or we decrease the position if the stock price is going up for whatever reason. So this is something very important. And Andrew, you say it's unique, but we do that all the time. I mean, we thought we were unique. It looks like now both are unique. You in the US and we do in Europe. We do that all the time because we have a family of 50 stocks that we love. We like them a lot. If one stock goes up 20% and other stock goes down 20%, it's a 40% change. So it doesn't make any sense not to do anything about that. This is a probability game. We don't know. I mean, we are talking all the time about beautiful business models, but there were so beautiful business models. I mean, we only talk about the successful ones, but what about all the beautiful business models that have collapsed over the years? I mean, you know, in the stock market, in the last 50 years, for the Nifty 50, how many stocks are left? Not many. How many stocks are left from the 2000 bubble? Well, nobody remembers American Online, Yahoo, and all that. So on eBay is there, by the way. Yeah, eBay is over there. But I mean, the sizing of the position comes every day with the news that are happening. So, and the twist that we have added is that if you go to a 3-4% position, well, you may need to have something interesting happening in the short term, because otherwise you may put the money in other companies in the portfolio. And this is not a question of degrading the portfolio, because actually you should know all the companies more or less to the same degree. I mean, no, the ones on the left, I know them very well, the others not, so I put money in a worst case. It shouldn't be the case. It should be similar situations, and the question is taking advantage of the law of probabilities. And besides, in Europe, we have the good thing that we don't pay taxes when we sell stocks. So it's almost friction-free, sell and buy. So we do that all the time. I mean, it's funny because people ask us, all these institutional investors, what is your turnover? I say, well, in terms of names, is not very large, but in terms of trading that we do, actually is quite large. It's above 100%, and that's what it is. I mean, it is.
During your career, you have invested in many small and mid caps in Europe, in Spain, here in Portugal as well. And now we are at the moment where there is probably a huge undervaluation of small and mid caps relative to larger caps. You mentioned flows. Like, do you think it's because of the flows? Yeah. Do you think it's fundamentals just because of the flows?
I think it's because of the flows. It doesn't make any sense that 500 million companies should be trading at 8 times, 5, 6 times, 7 times earnings, and the large cap at 18 times. It should be the other way around. I mean, there should be more growth in the smaller caps. That's a general comment. I mean, maybe I may be wrong.
What is the limit for that? Like, with all this passive investment?
I mean, we buy cash flows. I mean, we don't mind the size of the company. It's really funny. I mean, this month happened something it never happened to me before. I mean, we are starting investing in a company in an Asian country, one of the big six, and the company is 1 billion market cap. And after 1 week, we hadn't managed to buy even a basis point. I said to the guys, I mean, zero. You say zero here. I mean, no, we didn't get to the first basis point. So, coming back to the first thing, we have to be patient in buying, patient in holding, and patient in selling. I mean, we may be buying this company for 3 years, which may be the holding period of most of people. But 3 years is a lot for most of people, I would say. But that's what it is. I mean, you buy free cash flow, whatever is the size of the free cash flow or the size of the company.
Yeah, I was referring more than the limit of this trend of passive investment taking all the flows to the larger caps and not to the smaller caps. Like how this can end up. Guess that we cannot go to a situation where we are full into passive. Is passive investment more our friend, our enemy?
It's our free enemy, as they say now. I mean, it's obvious that as more stupid people invest in the market, it's better for the ones that we consider ourselves not stupid. So that may be a strong assumption, but that's what it is. If 50% of the money invested in the US now doesn't think, well, that's helpful for the other 50% of the people that think before investing. So the more the passive investing trend develops, the better the market for the ones that are thinking before investing. So that helps over the medium term. The enemy part is that over the short term you have issues with performing vis-a-vis the market, the clients, and all that stuff, all that noise. That's what is in our hands. We'll try to see which companies may take advantage of their own acts to close the gap, and these 6-7 times free cash flow will be converted in 12-13 times, 15, whatever. It's the only thing you can do.
To the extent that you can share that information, where are you finding value at the moment? Is it like geographies, like maybe you mentioned Asia? Is it small and mid caps? Is it certain sectors?
We are finding value everywhere. I mean, we are fully invested. We have knocking in the doors. I don't know. We have another meeting next week for new companies that I don't know how they're going to come into the portfolio. I mean, we find value in Asia, clearly, Hong Kong also, but in Southeast Asia, definitely. In Korea, in Korea, we just bought this year a company with 1 billion market cap with 1.5 billion in the bank, and a business that makes 300 million per year. So that's what we found this year. When some people ask about the efficient markets, of course, over the medium long term, markets are efficient, but in the short term, clearly not. So we are finding companies in France. We are buying one at 6-7 times free cash flow because it's French, but only 30% of the business is in France. I mean, things like that. Of course, in the oil sector, which now is oil and gas is our largest investment, with 10% in the oil exploration and 10% in services. So, I mean, we could buy so many interesting companies in the oil and gas sector, specifically in Europe, in which the banks are forbidden to invest in oil and gas sector. So we don't have competition buying free cash flow at 3 times. So that is what's going on.
We spoke about investment flows. Another relevant topic in the recent years has also been like indebtedness, leverage of especially governments. Is that something that worries you, like how this is going to end up? Or?
Well, as I say in my book, the last thing I say, if you learn something, is inflation is going to kill your portfolio. That was 10 years ago, and I still think the same. I mean, with electoral cycles, governments have to print paper, so money paper. And that's a fact, and it's very difficult to overcome that. And the fact is that we have to live with that. But after having said that, there is no other option to that owning assets, and that's what we do, owning assets. We don't know when government debts are going to let's say collapse or something happening. We just don't know. But inflation will come because it's the easiest way for the governments to get out of the problem. And if you have a company that doesn't have much debt and not much cash either, because I mean the value of the cash will go down in terms of purchasing power. So kind of stable situation, you will do fine. You will increase the price of your product and you will adapt to the new pricing. That was what happened in Germany in the 20s of the last century, or in Argentina at the beginning of this century. So we will do fine. We will suffer some hiccups here and there, but we will do fine as equity investors. Of course, I would recommend not to have anything in cash, both in the bank or bonds or whatever. I mean, because I will lose most of the money.
A bit more on the personal side, like you went from being a portfolio manager working for a company to being the owner of your own investment firm, being an entrepreneur. How you manage that? Because I imagine that when you are a portfolio manager, you can just focus on managing your investment.
No, I'm being very lucky. We have a team of 8 people in the management team, and I allocate 5% of my time to managing the company. We have a very good CEO with very good ideas, and I manage very well. I do exactly the same thing I did in the previous 25 years before I left Bestinver. Yeah.
Something I'm curious about, like we talk many times about the investment process and how important this is. Like, do you have like personal routines? I don't know, like have you been like, or do you like to exercise to clear your mind, spend time with the family?
Well, it's not every day the same things at the same time, but the same things every day, which is read the newspapers, read all the mails that I received, mostly from brokers, and meeting companies, talking to the team, and doing exercise, as you say, and have lunch and dinner, and breakfast also. So, I mean, the same thing I've been doing for 35 years. Hasn't changed much. I mean, now I read the Spanish newspaper Expansión online. Financial Times, I'd rather read it in paper. I prefer it on paper. The other online. So it's the same thing. You, instead of asking for download reports, you get to the websites, so easier.
Mm-hmm. I don't know, George, how are we doing in terms of time?
5 minutes Q&A.
But I have just one more question, so we can even start the Q&A, and it's more about like looking into the future, like how you see the future of our industry, how you see the future of asset management. Especially here in Europe, given that we are at an European conference. How is it going to change? Are we going to keep the same? What are the main challenges?
Well, I agree that it's going to be easier than has been in the last 10 years. I agree that the Standard & Poor's, I don't think they're going to perform very well in the next 10 years. So that will help all the active managers and the fund management industry in general, at least the active side. I would put a lot high probability on that. Not a certainty, but a high probability on that. We work on the assumption that global GDP is going to grow 3%, which has been the average of the last 45 years since China opened. I don't think that would change much. This 3%, Europe will be growing 0 to 1, like now. The US perhaps 1, 2. And the rest of the world 5%, especially Southeast Asia and India, of course. And that's enough for a global investor. I mean, 3%, that's really fine. I mean, we will have a couple of times in the next 20 years with growth of 0 or -1. We will have to live through that.
Yesterday you said at the dinner it's still easier to find undervalued companies in Europe.
In Europe, I mean, Euro is kind of no-brainer.
Than in the US?
We don't do the US. I mean, you go to New York and you have 1,000 guys that know more than you. I mean, and I see that when people ask me about the Spanish companies, US guys, very bright guys, they know a lot about the US market. They don't have a clue about the Spanish market. So I don't have a clue about the US market. So we have some investments in the US, but limited in situations in which, for whatever reason, we have a little insight that probably it's better than average. But you, as Warren Buffett said, the circle of competence is key.